most people run a business, and provided everything seems to be going on well, they're not aware of margins, they're not aware of ratios.
Don't start the business to become the business. The problem is you want to do everything. And wanting to do everything limits your growth. And something that is not growing cannot absorb anyone else. Instead of starting your business from scratch, you can actually just buy one.
That's true.
Most Kenyans want to start everything from zero. And we need that change of culture.
Most people don't understand the concept of valuation. They don't understand what metrics to look at. And even if they do, some people just have numbers but cannot, lay claim to how they got to those numbers.
We want when these players are coming into Kenya, coming into Africa, they're going to find you ready to be acquired. You're ready, you have your growth parameters in place, and it's just a plug and play thing.
Hey guys, welcome to our first episode at the African Checkbook Podcast, where we illuminate stories on African businesses and flows in Africa's private capital markets, one story at a time. My name is Linda Kiraithe. Today, we're having a conversation on money, mindset, and mechanics of African startups, because building a business is one thing, but building a business worth funding, worth acquiring, or even worth exiting is a whole different ballgame. On the chair today is Samuel Kagwe. Samuel is a startup consultant and a business exit architect. He helps entrepreneurs build businesses, scale, and get investor ready, whether they are raising capital or preparing for an acquisition. Samuel is the founder of XB67.Africa, a first of its kind structured ecosystem that connects investors and entrepreneurs, facilitating equity transfers and promoting or facilitating business acquisitions across the continent. Samuel is shifting the narrative. He's helping entrepreneurs build, have structure, and create value for their businesses. As he puts it, he's not only helping entrepreneurs build good businesses, he's helping them build good businesses worth selling. Welcome to the show today, Samuel.
Thank you so much. I'm very excited to be here.
I am excited too for our conversation today. And so today, Samuel, we start with funding for startups. Let us explore what are the different ways that startups can get funding and what are the different funding avenues available for them currently.
I'm not just excited to be here. I'm excited that this is the first episode. And, being a pioneer guest, that is so special to me. So I think most people are aware of the funding options that are available to them or that are supposed to be available, regardless of the fact that they are not available to them, which is the difference.
Yeah, true.
Yeah, for most people, you start with your personal savings, which is the personal level. And if you extend that level, you go to your friends and relatives. I don't know how many entrepreneurs are usually lucky to have relatives that are willing to put into your business. I mean, I know I was in the beginning when I was in campus, I had an uncle that found me to be industrial, according to him. And he would send a few thousands here and there. It wasn't enough, but did do something. And I know that is the story for so many entrepreneurs. If you don't have your savings, you have to rely on your spouse, or your partner. You rely on your mother. But again, it is something I realized that so very few people have that privilege.
Yeah, true.
To say that I'll start this business, and if things go wrong, my spouse will cover the rent.
Yeah.
For Kenyans, is if things go wrong,
you're on your own.
Your home. And that is tough. Then we have angel investors, we have venture capitalists, we have debt, and then we have growing through revenue, which is what is usually advocated for by most business strategists and whatnot.
True.
In fact, I would go as far as to say that you need to be profitable from day one, since you don't have that sort of fallback, something you can fall back on as an entrepreneur.
Is it realistic, though, to be profitable from
day one? It is. You just have to be very realistic with the kind of model you're working with. And it needs a critical understanding of the market infrastructure that you're getting into. If you're building, say, a social media platform, it will be delusional for you to say you want to be profitable from day one, because there are steps to that business model.
Yeah,
You
sure.
have to get creators,
Yeah.
and then you have to get the audience, and then you have to start introducing, say, ads. And you cannot introduce ads from day one. You have that market dilemma problem of chicken egg problem.
Yeah.
Do you get the creators first, or do you get the audience first?
Okay, all right.
So it depends with the business model, is the point I'm trying to make. And that is why, for example, in Africa, we do not have as many unicorns. In Kenya, we actually do not have any unicorn.
Yeah.
Because a unicorn requires patient capital. Capital that is going to it for up to 5 years. I think you're aware of companies like Instagram, companies like LinkedIn, even X, which took like 7 to 10 years before they became profitable. So it depends with the model. And in Kenya, we are limited in that way, or in the African ecosystem, we are limited in terms of even the businesses we can pursue because of the capital alternatives that are available to us.
Okay, I agree with you, but just viewing it from most people's perspective, most entrepreneurs, or some, are not finance guys.
Yes.
So they do not know about keeping books of records. They don't know about financial ratios. I think if you could ask me, most people run a business, and provided everything seems to be going on well, they are not aware of margins. They are not aware of ratios. They don't know what they don't know what EBITDA is, or what EBITDA is supposed to show them, or it's supposed to mean. And so, even though you say there is no unicorn or patient capital, don't you think that investors or funders would have a challenge if they were to say, get interest in a certain business? Because entrepreneurs themselves, in terms of how businesses in Africa are structured, I feel like, first of all, there's a challenge that there are too many small businesses, and most people do not have a vision of how will they scale this business. Do they want to raise capital after 3-4 years? After how long do they want this business profitable? And what you've talked about, do you get creators? At what point do you start marketing? What marketing avenues do you consider? I think most entrepreneurs do not do that. So it's just, for the successful ones, you could say maybe it's luck, because they got into the right market at the right time, provided the right product.
Let me interject you. This is going to sound very unfair, but most of the entrepreneurship that we see in our market is usually a survival tactic.
Yeah, right. Yeah, I agree.
It does not come from a place of, I want to solve this problem. It comes from the place of, how do I make money?
Yeah.
And therein lies the problem.
Yeah.
Someone who is just interested in making money is not going to think about corporate structures.
Yeah, true.
They're not going to think about EBITDA. For them, it's about
I'm making line. Money. Yeah.
How much do I put in? How much do I get out?
Yeah.
So to capture the main point, the capital options to entrepreneurs are limited because the entrepreneurs themselves sort of limit their reasons of getting into entrepreneurship. And maybe I won't even blame them, because we as a country are surviving. They're in the survival stage.
That's
so true. And that will translate down that pyramid. Most of the entrepreneurs are doing this to raise rent. And that is why you're seeing businesses close down after 2 years. Because if this guy realizes this is not paying my rent, then there's no need of
the
doing
venture
it.
is no longer of interest to them.
I came across a very interesting social media page. In fact, there were 2 of them. And there's these guys who are selling businesses. And I was like, wow, this is amazing. Let me check them out. I was quite disappointed to find that the kinds of businesses they are selling, they do not qualify exactly for businesses I would categorize as ready to be acquired or to be bought. These are salons. They are retail shops. They are the kinds of businesses
Are they like
where
a franchise or?
no, reja businesses. And
I get you.
I tried to look at the valuation of these businesses, and it was laughable for me.
Yeah.
Because you find the guy probably has stock of 160,000. They say the rent is 20,000, and they're charging for the business 400. I'm like, why? I mean, does it come with any system?
Yeah.
So, and I think that is the other point which we have mentioned earlier. Most businesses don't have corporate structures, don't have systems, don't have SOPs, and so they are unsellable. And by the mere fact that they are unsellable also makes them not ripe for investment.
Yeah, true.
Because an investor is going to put in their money into the business, having the business itself as the product to them.
Yeah.
They are not interested in the recurrent revenue or profits.
Yeah.
They're interested in the potential of that business.
Yeah.
And they're interested in exiting at some point in the future. So if you're building a business where you're doing everything, I've been discouraging entrepreneurs from being the ones who are doing everything. You shouldn't be the accountant. You're the marketer. You are the developer. You are the CEO. So it makes it impossible for someone to come and say, let me put in 1 million shillings into your business, because that will simply mean I'm putting money, I'm investing in the person.
The person, not the business.
Not the business.
Yeah.
And if anything happens to this person, there goes my money.
That's true. I like the point that you talked about, that entrepreneurs do not start business to solve a problem or to close a gap on something. And I'd like us to just think about creation of jobs in Africa or in Kenya. There has been complaints that government is not doing enough. There are no white collar jobs. That is the reality. But then don't you think that there's some disconnect in that there's so many small businesses, but very few jobs still? So then that means, is it that entrepreneurs are not opening businesses with the I am an employer mindset? That this business, as you had said, could have an accountant, could have a developer, could have an IT guy, could have someone cleaning, which are sources of jobs. And looking at where Africa's population is going and the growth that we are experiencing, of course, we are not going to see any more increase in white-collar jobs. But don't you think that with a focus on creating solutions, and if all entrepreneurs started or founded businesses with the mindset that I am an employer, then we could be able to close this gap on unemployment as a continent. And of course, for us to do that, then it means we have to start businesses that focus on value addition. We have to tap more into agriculture, because Africa has the largest percentage of arable land in the world. So there's a big gap in agriculture, and young people these days are not considering that. But if you look at the potential in value addition from agriculture, then we can create more jobs. So don't you feel like we have a challenge as young people and as Africans to have the I am an employer mindset instead of...
It's a very deep question. I am leaning towards saying nobody starts any business to solve the job crisis anywhere. Like, if you meet an entrepreneur who's saying, I'm starting this so that I can solve employment, they're kind of delusional. Their priorities are kind of in the wrong place. So yes, you start your business with the goal of making money. But then it is nuanced in the sense that don't start the business to become the business. The problem is you want to do everything. And wanting to do everything limits your growth. And something that is not growing cannot absorb anyone else. You've mentioned agriculture, and I want to pose back this question to you. You've mentioned agriculture to say that focusing on agriculture would sort of absorb more people into the job market. But we're in 2025 and we have AI, we have automation. If you look at the developed countries, like let's say how Israel does its agriculture, it's the machines that are in the fields.
That's true.
So what exactly are you trying to capture with?
You're right, actually.
That is a question I'm posing back to you.
Well, I think, first of all, I'll touch on on agriculture in terms of impact, that is from the smallholder farmers' perspective.
Okay.
Where even though Africa has the largest percentage of arable land, it's not by large-scale farmers. Most people are smallholder farmers. And so if, say, one was to create a value addition company, say on avocado, making avocado oil, you would then not go back to start buying land to plant avocados, harvest your own avocados so that you process them in your own plant. You will get these avocados from farmers somewhere. And so these farmers, whether they are young people or not, are getting source of income. And that is employment in a way. 100%. Because employment does not have to be waking up, cleaning up, wearing a nice suit and going somewhere. Provided you're making money, that is employment. So I'm looking from the impact side of it in terms of that Africa, most of us are most of people would be smallholder farmers in comparison to maybe other countries like, say, Israel, where they are doing farming on large scale. So you just need one farmer, millions of machines.
That makes a lot of sense. Yeah, so that's. I'm also reminded of this idea that African countries are trying to leapfrog into the, say, modern world and thinking they can skip industrialization or the agricultural revolution.
That's true. Yeah.
And therein lies also another problem, because there's a disconnect between how the modern capital is being deployed and how structured our market is. We are trying to get to the modern world. So, for example, we are trying to do the value addition that you're talking about.
Yeah.
But did we even learn that in school?
No, definitely not.
We didn't even learn that in school.
Nobody taught us that.
So we want to do, say, there's a time I was in Meru and we saw a certain plant and we wanted to do some value addition. Where do you begin?
Good question.
Say agricultural, value addition is very cash intensive thing to do.
Yeah. You need so much work.
If we were in a country like China, we would simply go to an existing factory saying, this is the plant we have, we want you to extract ABC. But I have no idea where I would begin. And maybe that is a problem with the government. Maybe a story for another day.
So that means even in entrepreneurship, there's a lot of challenge in research, in knowing where to start. Like there are no systems or processes or procedures on how do you do this, where do you go, to what office would you find documentation on how to do or how to process this thing. So I do agree there's a challenge in that. But also, as you've said it, there's a problem in African businesses, or when looking for capital for African businesses, we want to structure it as it is in the modern world or in the global markets. So this gap that you feel, do you feel then like that Africa deserves its own capital playbook that understands our system? And how would this look like then if you were to have one?
100%. But there's two sides to it. We first have to look inside before we look outside. And that means we need to tell entrepreneurs to have three things in order. The first one always has to be a clear path to revenue, if you don't have any revenue, or a clear path to profitability, or a clear path to growth. You should have that figured out even as you start a business. You don't jump into a business and then ask, how do I grow it? You sort of have to reverse engineer it and see this is a big enough opportunity. The total addressable market is big enough, and then I'm going to start with this niche, and then I'm going to expand like this, either by product or by region, etc. Number two is you have to work on systems and corporate structure. That one has to be set, maybe systems as you go, but the corporate structure needs to be worked on from day one. And then number three is the legal compliance. You'll be surprised that the number of people who are, say, calling themselves entrepreneurs without even a corporate outfit. Guys are just swinging it. They don't even have a county license, nothing. So if I want to buy your business, what am I buying? Am I buying air? You see, what am I investing in air? So that is the first thing we have to tell people. And that is the first side. Now, on the other side is what you're talking about, a new capital outfit. And I want to get into how capital is being sort of put to use or put into the market right now and how it is being recouped.
Yeah.
Ideally, how investments work is I'm supposed to invest, say, X amount, and then I'm supposed to recoup that as a multiple at a certain liquidity event or at an IPO. Now, IPOs in Kenya, it's a whole other story.
Yeah. It's a topic for a whole another day. Yeah.
Secondary markets and those acquisitions and mergers, they're there, but almost inexistent.
Yeah.
Now, what is happening is that people are still investing. Most have switched to debt, but the ones that are investing using the normal models are going about it this way. If I invest 1 million Kenya shillings at seed, I want to recoup it at Series A. And the ones who invest at Series A want to recoup at Series B. The ones who invest, and it goes like that. And this brings problems, a lot of problems. Because number one, the investors are now pushing the entrepreneurs towards, I would call them vanity metrics, and making a lot of noise so as to attract the next investor.
The next investor, sure, yeah.
And once these ones come on with their 5 million, they also want you to deploy that capital as soon as possible, make as much noise as possible, spend it as quickly as possible, so that the next investor comes on. But now what happens when you don't have another investor lined up?
Yeah.
That model crumbles. And that is why, for example, you're seeing a lot of businesses that are closing down.
Yeah.
They raised $20 million and they're closing down. You're like, what?
That's happening? Crazy. Yeah.
And most of them will crumble at Series B because it's very rare you need a very big investor for Series C.
Sure, yeah.
And therein lies, that is the problem that you're talking about, capital structure. A new capital structure entails us rebuilding it from the ground up. And what we need mostly are exits, redefined and structured exits. And which is what I'm working on, but we're going to get to that in the end. We need the secondary market to be very active, such that even if I invest 50,000 Kenya shillings into a business at starting, I can feel confident that I can sell my equity to someone else at some point without necessarily hoping for a fundraising, the next fundraiser to come in. We need an ecosystem where I can take my equity and I can put it out back in the market and I say, I invested 50,000 into this company, but I want to get out. Who will give me 70,000 Kenya shillings? Someone comes and gives you 70,000. That is going to change the whole ecosystem. Because number one, companies are going to have capital that is readily available. People are confident that I can put in my money, I can take it out. When these businesses grow, now we're going to get into what you're talking about, job creation. Because they have the money to employ people. And then that system is going to now sort of turn into a cycle that sustains itself, because now even the external investors have the confidence to come in and now deploy bigger capital. So say set up a factory or whatever else. And now that becomes a self-sustaining cycle. But how it is right now, it is breaking at some point. And that is why we are so frustrated with the funding sort of structure we have in Kenya. We're like, who is getting this money? It is actually the people who have learned how Silicon Valley operates. People who have learned how to create these pitch decks and presentations. And we know them. So what they will do is they will build the first company, raise $10 million. When that system crumbles, they just close it down, say, hey, we had a disagreement of management or logistics issues or whatever. They go and create another corporate outfit, start again from zero, raise $10 million, do the same thing. I mean, you can't blame the player. You blame the game. But now what we are saying is we want to change that game. We want to do an overhaul of the entire system. And sorry to say, but the government is not going to do this.
Definitely. We are no longer waiting for the government to do this. I think Africa's governments right now have so many problems. They're on their own, like government-centered problems. So much debt to pay, pressure from the people. Gen Zs are changing voting population. So there's so much. But I like that you say that we are not reliant on government. And we ourselves have the power to change. What the work of the government is to just provide systems, a peaceful and conducive business environment, and entrepreneurs take up and investors also take up the challenge. So there's something that you've mentioned that I'd like us to talk about more. You've talked about pre-seed, Series A, Series B, and I would like us to talk about angel network. Or is there an angel network for investors? And where can startups find these networks? Are they existent in Kenya specifically? And also, I'd like you to touch on the possibility of capital avenues such as grants and how investors can position themselves to receive such funds to start a business or to fuel early stages of business growth.
Okay. Angel investors.
Yeah.
So angel investors are simply individuals like you and I. And they are, I would say, individuals that are not really experts on investments. I could be a doctor and decide to be an angel investor. There are people who are educated, or they are aware, they are conscious of the fact that they don't have to invest in the conventional channels. So what they do is they try to identify these businesses that are growing. And I actually encourage a lot of people to try and become angels. So that one graduates and becomes angel syndicates. So angel syndicates are individuals now, they pull together as a group so that they can access better opportunities or they can access better information, better knowledge, blah, blah, blah. How can startups access such groups? Now, the unfortunate thing about investments in Kenya is they happen through warm introductions. So I would encourage an entrepreneur or a founder to try and get into these spaces before you can ask for money. And it is simple. I mean, we have the internet. You can just Google angel syndicates in Nairobi. You'll find the Nairobi one, which is the most noisy or the most heard of. So try to get these warm introductions. Personally, in the beginning, I had an email of investors, a whole database. I had access to it. So there's this investor, what industry they invest in. Here is their email, the name of their company, blah, blah. And I would start emailing them.
Cold calling and cold emails. Yeah.
And I will shock you and tell you I got maybe 1 out of
that happens.
A response.
That happens with cold emails. You are lucky if you got a response, actually.
I tell you, that one probably 1 or 2.
Yeah.
And it was probably a no. It was actually a no.
rejection, yeah.
It was actually a rejection. So that is the first thing I want to point out about angels. There was a second question.
Where can startups find them?
That what we've said is just Googling. Once you have that information of who you're looking for, it is easy to find them.
The second question was on grants.
On grants.
So, first of all, what is a grant? And how can startups take advantage of this capital option of grants?
Let me tell you, on grants, there's a problem. I'm actually against grants. Grants are ideally supposed to go towards businesses that have some sort of social impact. But then, us being Kenyans, we learned the game. And what people are doing, they're creating now these corporate outfits with a lot of jargon on what social impact they're doing. They're going to maybe children's home, they take a few pictures. Now, the unfortunate thing is that these institutions that are also giving these grants do very little to say, do the, what is it called? A background check. They do very little background checks and they do very little checks after giving the grants. I don't know how to call, I'm forgetting the technical term, but to sort of check that the money went to do the right things.
So there's very little due diligence.
Very little.
Yeah.
After the fact.
After the fund.
Yes. So guys are raising this money for their own personal agendas. And what happens is that now the genuine businesses that are supposed to get this, the businesses in operation, they don't get this money. Then these guys close down shop again after hitting said milestones, and they open another corporate outfit with the same agenda. The reason I'm against that is because, number one, it is having a negative impact on investor confidence in our market.
Yeah, true.
Because these guys will feel like they've been conned once, and once bitten, twice shy.
Yeah.
You'll have a very big problem. The genuine social impact entrepreneurs are having a big challenge trying to convince the investors to give them these grants.
Yeah.
And I tell you, I see the entrepreneurs on social media. They are very loud, by the way. They are in sectors like education, the ones that hit the SDGs, the social development goals. So education, health, you can imagine those sort of areas or topics that in Kenya,
women,
solar, I don't know what's
energy.
I don't know, climate.
Yeah.
So I'm against grants because you're not giving away any equity, which means you're not getting any sort of overview or you're not accountable to anyone, in the long term. Yeah. So that is my position on grants. If I were to be asked, let's do away with grants.
So speaking of what you've said about giving equity and being accountable, when investors are looking for opportunities to put in capital, I know there are several factors that they consider. Maybe we could touch on what are those factors. And I think we discussed them at the beginning, but we could summarize them. And then what else can investors in this system that you've talked about, where people put in money and they're confident that they can exit this business at any stage. So what other value can investors bring to businesses to also facilitate faster exits?
Yeah. I like private equity because private equity understands that aspect of bringing in value apart from the money, additional value apart from the capital. And that additional value can be in terms of now restructuring that corporate structure.
Yeah.
It can be in terms of network, expanding the network of that business. So say connecting the founder to more investors or distributors or whatever. But now, there are key things that an investor will look at before putting money into your business. And remember, we said their key concern is usually the potential, the upside potential. You can do a few things to demonstrate that potential.
Yeah.
And that is on traction. So if you have just an idea, it might be difficult for them to put in money because there's no evidence that this will bring in money. But again, I was very shocked to find out a few months back that an investor sometimes would be willing to put in money into a company with no revenue rather than one that has, well-established revenue.
Sometimes it depends with the story, the product, the market.
100%.
Yeah.
Now, the thing is, with a company that already has revenue, it can actually represent a limited upside.
Yeah.
Because they can look at it and evaluate and see the best. If you're doing, say, 500K a month in revenue, the best it can go to is 800.
Yeah, that's it.
So that's it. But someone can have an idea that is so big that they're like, if this gets to market, if this actually goes well, then we are going to...
Isn't that what happens with most tech startups?
It does.
Yeah.
But now in our market, I'll be honest, I don't think it's... The investors are usually a bit skeptical.
Yeah.
So you should have that traction. And that traction doesn't necessarily have to be money. That traction can be in terms of your wait list. So yes, you have an idea and you're building it and you've put it out there and people have signed up on your
You have
wait
customer orders.
Or pre-orders.
Yeah.
It could be a physical product, say you're creating a makeup brand or whatever, and you have pre-orders. And it could be now the actual revenue.
Yeah.
Where you don't have to be profitable or you don't have to be to have broken even. So those are the two things mainly. So traction either in terms of promised customers or in terms of revenue. If you have that, I will have some confidence. And then now I'm going to get into the nitty-gritties. So I'm going to look at what systems do you have in place such that it is not unheard of for investors to come in and do a complete overhaul and bring in new people.
That's very common.
Because the idea can be bigger than the founder.
That's true. Yeah, that's very common. Restructures.
The business opportunity can be bigger than, say, the qualification of the one who had it. And that's crazy. Yeah. That's what leads to, you hear a founder has been moved out of their own company.
Yeah. And that's the complaint with most people have with PEs, that they come in, complete overhaul of the business. The founders somehow, like in some cases, will like marginalize or disappear or look like they're not even existent in that business. But as you said, sometimes the business idea is bigger than the founder.
Which is crazy.
And at the end of the day, money has to be made, yeah?
Money has to be made.
Yeah.
And another point on that is that when a business idea lands, I learned this as an entrepreneur, it doesn't land on one person. You can have a business idea in the confines of your bedroom. Just you and God.
Yeah.
And you haven't even written it anywhere.
Yeah.
And then you're listening to someone talks about the same idea and you're like, exactly the same. How?
Yes.
How does that happen?
Yeah.
So when I learned that, I realized again, speed is of the essence in startups. So once you get that idea, how quickly are you doing things? How quickly are you hitting milestones? That is also going to be important for the investor. So if you had the idea 2 years ago and you have traction, but it's not meaningful traction, you have, say...
And probably someone else is already doing what you're doing, but with bigger milestones.
Then they will not invest in your company.
Yeah, that's true.
And then most founders, the ones that get funded, they have to think of the exit.
Yeah.
What is your exit plan? And the exit plan is usually sometimes directly connected to the systems you have in place, the SOPs.
Yeah.
So how do you get your clients? What is your customer acquisition channel?
Yeah.
Have you standardized your customer acquisition costs? How do you do your marketing? So who are your suppliers?
Yeah.
Do you have any sort of, what do you call it? Exclusive deal, exclusive agreement with them? If you have an exclusive agreement, say with a supplier, it actually adds to your valuation.
Are you a price maker or are you a price taker in the market?
Yes. What else? I've actually been building a tool for valuation, and valuation is actually the most difficult thing to do.
So now that valuation is not taught in schools, what can entrepreneurs do about that?
I mean,
since most people don't understand the concept of valuation, they don't understand what metrics to look at.
Yeah.
And even if they do, some people just have numbers but cannot, lay claim to how they got to those numbers or put in solid evidence and solid or a solid case to defend the numbers that they have.
Well, I think it's a fair question, but I'll defend the entrepreneurs and say I think most entrepreneurs are very proactive, and it's just a matter of research. I mean, but maybe what we can do for them is actually lay out a few of those valuation strategies or techniques or models. I will say the most common is the earnings multiple, profit multiple.
Yeah.
So how much revenue do you have? And that can be multiplied by a certain number depending on the industry that you're in.
Yeah.
Now, identifying that industry multiple again is the issue.
Is the issue, yeah.
And then we have the asset model. I'm forgetting how it's called. Where we look at your assets, we look at your liabilities, we give you that valuation.
Yeah.
There's an interesting one, which is the cost. What do you call it? The valuation model tries to identify what it would cost to build an exact business to the point where you're at. And then that is the value of your business. Then we have the DCF.
Yeah.
Then we have... there's usually one where you compare
cash flow analysis, free cash flow valuation.
Yeah, you can also compare with other players in the market. How much are they exiting at?
Yeah.
So there's all those models. And
so it's up to entrepreneurs to do research.
Yes, but you need to be aware of at least one model from day one.
Yeah.
And then now we start piling on other things. Like if you have a system, we can have we can add some basis points. If you, it's very nuanced. So we'll have that actually on the platform, for free.
Could you speak more to this platform, this platform that you have, not just on the valuation, but how are you connecting investors and entrepreneurs, and how can investors use your platform for exits or for acquisitions?
All right. So remember, we said you need to build this ecosystem from the ground up.
Yeah.
We do away with the current capital logic that we have. And I can't do everything in that ecosystem, but I have identified at least two that are important and maybe needed more immediately. And the first part is to have an exit, like a structured exit marketplace, where if I want to buy a business or if I want to sell a business, where do I go? And maybe let me point that as a side note. Businesses are usually bought, not sold.
You don't sell. Your business is bought.
The business is bought. You can never sell your business. It's just bought. But anyway, so we are building that marketplace where you will come and list your business for whatever reason that you want to exit. It could be you want to relocate, you want to retire, whatever. We want to raise extra money for another opportunity. It could be all that. You list your business, you give your valuation, then there's something that we are calling an exit score. You build your exit score. And an exit score is just determined by how ready you are to be acquired.
Okay.
Do you have your papers in order? Does the CR12 match your illegal name? Things like those. And then you get that exit score.
So how long does that take?
You will also agree that sometimes deals can take up to 6 months.
Actually, yeah, due diligence is a very
critical,
intense and long process.
But we've set it out in about 12 steps. And 12 steps that will take you maybe at most a week if you're serious.
Oh, wow.
So you just give the basic
information. That's too efficient. That might be the most efficient due diligence system.
Now, unfortunately, we cannot automate the entire process. So there's some parts that we're having to do manually. So, for example, when you upload your profit and loss statements, we're analyzing that manually.
The legal due diligence.
Yeah, we are the tax, at least things like tax compliance, that one we have, the KRA has APIs that we've connected to. But it's about 12 steps. And if you get everything right, or if you give all that full information in those 12 steps, you're good to go. Then now there's the side of the buyer. We are trying to provide value in terms of matching a buyer and a seller in terms of the industry, in terms of the stage of the business, in terms of the model, in terms of
so you're saying on this system, there's a side that buyers can. So if one is an entrepreneur and the other person is an investor, their view on this system will be different.
Very differentiated.
So the buyer comes in, says, I'm interested in the beauty industry, maybe a specific line. Do you have such a business? And then you provide the information. That's what you mean. Okay.
And we'll be doing due diligence on all the businesses that we are listing. Because there's also the aspect of security.
Yeah.
And
some confidence.
Yes, confidence.
That these are legit. Yeah, that's true. Yeah, there's a lot of that, and I like that system. I like that you're coming in as a solution provider, because for so long there has been a lot of discussions on the fact that there are no exit opportunities, even for investors, especially from an investor perspective.
Yeah,
where people are like, yes, I can put in money, but
at what point
do I get my money back?
Yes.
Before, when IPOs were vibrant, people would be like, that's an option. But I like that you're coming in as a solution provider, not just for these investors, but also for entrepreneurs who have very good, solid businesses. They've worked to create structures and put their businesses in order, put their story in order. They know they have a business strategy 5 years into the future, but do not know where they do not have a rich uncle somewhere or a rich guy somewhere they could approach and tell them, give me 10, 15, 150 million for this business that I have.
But there's also a need for public education on the fact that instead of starting your business from scratch,
Yeah.
you can actually just buy one.
That's true. That's true.
Most Kenyans
Yeah.
want to start everything from zero.
Yeah.
And
That's
we
true.
need that change of culture. And it's something that I'm trying to educate the public on, because there are very many reasons why you shouldn't start from scratch.
Yeah.
The biggest reason being 90% or more of businesses will fail.
Yeah, that's true.
Why would you start from zero when you can take something that is already proven?
Yeah.
And businesses are not usually that different.
Yeah.
If you have a differentiating factor, just go acquire one and then bring in that differentiating factor into that business. You will do much better.
Yeah.
I have met moneyed individuals who say, where do I invest?
Actually, I agree with you.
They tell me I've bought all the apartments I can buy. I have bought all the stocks that I can buy.
That was a common question when I was in investment banking.
Yeah.
People would be like, I have bought all the shares. I have bonds. I have treasury bills. I have real estate. Now what?
Now
you look at them and you're like, we just have to keep buying more bonds for you.
We have to build this culture of buying businesses. And sometimes not to buy the business and run it as an individual entity, but also doing what we call amalgamation, or the merging companies.
Yeah.
So you're coming into an industry like the beauty industry. You identify the top 10 players, combine all of them and into one brand. That will be much more powerful. Now, I'm actually reminded of this other concept of franchising, but that's another topic. That will be much more powerful than you going to start your individual, brand from the ground up.
But I like the concept of franchising because it saves you a lot on marketing.
Yeah.
You go, say, this well-known salon or well-known kinyozi somewhere. You take their name. If they operate in Nairobi, they've done social media marketing, they are well known. You go open your own somewhere in a different town, and it saves you the cost of marketing. And all you have to do is now run the nitty-gritties of daily operations of the business. So I like the concept of franchising, and I like that you're encouraging us as Africans and as Kenyans to start investing in our own businesses.
Yes.
Actually, I remember this week we saw news on Pullman Tours, where Aliko Dangote's tour company bought that tour company and will now be operating it. So that is one way.
Yes.
He chose not to come here and start his own tour company from the ground up.
Too much work.
But too much work. But buy a company that is in existence, has assets, has liabilities.
Yeah.
And for him, it's just put the value proposition that he has for that and run the company. So I like that.
The other important point I would wish to provide is that the Western markets are near saturation. The markets for the developed countries are near saturations, and the big companies that are there, when they are thinking about growth, they are thinking about developing markets like ours.
Yeah.
So we are building this ecosystem in preparation for that.
Yeah.
Because when they come here, they shouldn't start from scratch. They start by acquiring the current players.
Yeah.
But where will they get them? How do they engage them? In fact, I usually tell founders, if you're looking for a business idea, one place you can look is these big companies. Go and evaluate their growth strategies. And then build a very small part of that company and just anticipate them.
That's true.
Just anticipate them. So we want, when these players are coming into Kenya, coming into Africa, they're going to find you ready to be acquired. You're ready. You have your growth parameters in place, and it's just a plug and play thing.
All right. Thank you so much, Samuel. I believe our discussion today was enlightening to our listeners and our viewers. And I believe as potential investors in businesses and potential entrepreneurs, or if we are already investors and entrepreneurs, we've learned something from this show. And let's continue to fund Africa together.